Hello, guys. Welcome. Thank you for joining us today. We're going to do a um, presentation on mutual funds. Okay, mutual funds. Right. So mutual funds are basically they're safe. they're safer than individual stock picking. And let's talk about some of the reasons why they may be safer and what they are exactly. And I'm not going to read all of this to you guys word for word. I want to just give you a brief overview as to what they are, okay? This is not, mutual funds are not discussed in my seminars or my classes. However, they are still items in the financial world that you could take advantage of. I mean, you could actually own some mutual funds along with the individual holdings that you have, okay? But let's just talk about what they are. First of all, they're managed by professional money managers, and they allocate funds across a spectrum of entities with the hopes of giving you guys a nice return, okay? And they can be stocks. When they say portfolios of equities, they mean stocks, bonds, and other securities. Okay? The value of a mutual fund depends on the performance of the securities that they're buying, just like it would in an individual stock. The difference here is, you don't have any shareholder rights. You won't get a proxy to vote on these particular individual stocks like you would if you were a direct stock holder. Many of you have gotten those proxies in the mail, or you get them through email. They talk about, things to vote on, this, that, or the other. With a mutual fund, you won't have that. And you can understand why. The average mutual fund here is explained here. The average mutual fund holds hundreds of different securities, all right? So you're extremely diversified by owning a mutual fund, all right? Some of the pros: liquidity, meaning you can go in and out of these things without much effort. They're very diversified, minimal investment requirements, which means you can get in a mutual fund fairly cheap. You do have the advantage of the professional management, and you got a variety of mutual funds you can buy from. Now, the cons, of course, there are cons there. You got the commissions, right? There's been handled by professionals. You're going to have fees and commissions there. There's no FDIC coverage on mutual funds, large cash presence in portfolios, which means, some of these mutual funds could be sitting in liquid cash. We call, when we have money out there on the markets working, we want that working. And lack of transparency in the holdings, which means, as a professional money manager of that mutual fund, they can make decisions without you knowing much about it. So, all right. There are a few ways that you can earn a return off a mutual fund. Income from dividends on the stocks, in the funds. If the fund sells securities and those securities have appreciated in price, this third one, if the fund holdings increase in price but are not sold, you do have an appreciation in the value of that mutual fund. Okay. Now let's talk about the types of mutual funds real quick. Again, I'm not going to read all of this verbatim for you, but there are equity funds, which are primarily stocks that are out there. It can be, aggressive growth, income-oriented values, or any other method that they want to buy these stocks under. Fixed income funds. Fixed income mutual fund focus on investments that pay a set rate of return. So government bonds, corporate bonds, debt instruments, that you can have a mutual fund with those types of entities in them, okay? Index funds, right? So these are extremely popular in the last few years. They fall under the money care index funds. Their investment strategy is based on the belief that it's very hard and often very expensive to beat the market consistently. So they just say, hey, let's just get a fund that follows the indexes out there. The S&P 500, Dow Jones Industrial Average. What does that mean? That means if the S&P 500, which you guys know is the top 500 companies out there, if the S&P 500 goes up 5%, your index fund that follows this will go up 5%. That's the same thing with the Dow Jones. If it goes up 2%, your index fund will go up 2%. So they're hedging and saying, hey, we just want to go with the S&P 500 or the Dow Jones. That is the number you guys see on a regular basis when you say, oh, the market's up and it's up 300 points or 500 points or down 200 points. They track these major, the industrial average or this S&P 500. Well, if you get a mutual fund here And there, you will have your return to mirror this, the S&P 500 or the Dow Jones, okay? There's another type, balanced fund. Sounds pretty self-explanatory. You know, they just kind of have a hybrid of assets, stocks, bonds, money market instruments, just everything across the board to reduce risk. Think about it. If you guys, let's say you come into a whole lot of money, right? You say, hey, I got X amount of dollars that I am investing and I got this going and that going. I just need this money to just sit there. Don't be too risky with it. Just put a little bit, just put it away. If I can get a slight return, I'm fine. I just need to have X amount of dollars there, you know, in 5-10 years. So you'll get a balanced fund for something like that. It's just going to give you a balanced approach to the market, conservatively invested, and hopefully give you what you're looking for. Think about the big picture, guys. When you get, you know, that whole pinwheel we talk about in our investing courses, when we talk about the strategy around building out their portfolio, imagine sprinkling some of this in there as well, okay? Money market funds. Again, safe, risk-free, short-term debt instruments, treasury bills, things of that nature, okay? Income funds, again, something to provide income on a steady basis. You know, these funds invest primarily in the government, high-quality corporate debt, those things, holding these bonds until maturity in order to provide an interest stream. So when they pay interest on the debt, that's when you get paid. So when you're into things like this, you can get paid off the interest on these bonds. So that's an opportunity out there for you as well. International global funds, again, just investing internationally. When you're mixing in a balanced portfolio, you may want to consider some of that as well. Specialty funds that go into special categories in our economy, special sectors, financial, technical, health, technology, health, so on and so forth. They go specifically in those areas and they invest in those types of funds, specialty funds. So again, so look, you see one here, socially responsible funds. So anything you want to put your money in, you can go out and find a mutual fund to invest, that's already investing to invest in, right? So if you had a certain liking or a certain thing going on in the economy, you can do that. Especially fund could be the marijuana index industry. It could be the, you know, the green effort. You know, we're talking about the green economy with the pollution-free economy. They got certain companies that are out there doing that. You may want to invest, say, hey, I want to invest in a mutual fund that's capitalized off of that opportunity, okay? ETFs, I covered that in a different presentation here, but again, that's just an example of a type of, you know, fund that you're able to invest in. Again, see the other ETF presentation there, and I'll talk about that more in detail. All right, for more information, again, go to sidemoreinvestments.com or reserve.sidemoreinvestments.com, where I am having training opportunities for you guys. I hope to have you soon. Thank you.